Joining us right now on the Squawk Newsline is Chris Whalen of Whalen Global Advisors. That's the question of the morning. How much should we be concerned about these other banks, Chris?
Well, it really depends on the institution, but, basically the Fed has caused a large unrealized loss to be embedded on the balance sheets of many banks, and I think they are going to have to go back to the drawing board and understand that they can't raise rates much more. When you have a bond market and a mortgage market that's concentrated as much as it is today because of quantitative easing, you can't raise rates that much or you make everybody insolvent. This is kind of basic, bond market 101, but apparently the board in Washington did not see this. So now they do.
So you point the finger at the Fed for this?
Oh, yeah. You can't manipulate the bond market and change the term structure of interest rates and then come in and raise interest rates 500, 600 basis points.
But it's been a relatively transparent. I mean, to think this was not coming. I mean, I know there's a lot of people who are very angry at the Fed. I don't understand why people are more angry at the Fed than they are at the leaders of these banks that, frankly, should have known it was going to rain and didn't have umbrellas.
You cannot blame the bankers for this, Andrew. When
you
the
can't
government
blame the
comes
bankers?
in, no, because the government is manipulating the market. The bankers ride on the market. They float on the surface, and they have to manage their institutions mostly in a short-term sense. I'm not talking about Silicon Valley Bank. That was a hedge fund and drag. That's different. But what I'm saying is,
drag, you call it.
Oh,
I like that.
Absolutely. Well, think about it. Why did they go long mortgage backs? Because they knew that their warrants and the stuff that they really depended on for their earnings, which was tech companies, was going to have a bad year. So they figured, well, the Fed's going to pivot. Let's load up on mortgage backs and hit one out of the park. That's not the way you're supposed to run a bank, right? So, they deserve what they got. Then you look at Signature, different story. Reputational risk, crypto, the whole bit started to run. Very different sort of situation. But for most banks, they did the right thing. They bought risk-free securities, and then the Fed buried them. So, I think Elizabeth Warren, by the way, is absolutely right to slam Powell. She's absolutely right.
Chris, let me ask you about First Republic Bank this morning, because even while other regional banks see modest declines, even some modest gains, First Republic is down almost 30%, and we have these reports about a possible sale. What was the problem here? And what is the solution here? And what do you make of the response by authorities this week and to some extent dragging this out?
Well, First Republic, again, different story. Big muni book, okay, number one. It's not a particularly strong performer in terms of profitability. It's high touch, high expense asset manager. And I think they will get bought. The AUM that they have, the clients, is very attractive. The bank itself is, to me, one of the examples of a business model that flourished over the last 10 years during the period of benevolence from the Fed. But these business models may not do so well in an environment where
what is the problem, Chris, with the muni book? I mean, I'm looking, not that the MUB is a perfect proxy, but we're talking about muni bond prices that fell, less than 10% year to date. Okay, we had a little bit more selling pressure last November. Why would their muni exposure be so problematic here?
Probably unhedged. When you buy securities held to maturity, you buy them for credit. You're not going to hedge it because you're going to spend the coupon hedging the security or more. The muni market has been trading very strangely over the past couple of years, as you probably know. And, again, banks make choices about assets. But I think the real reason that First Republic's in trouble is that they're just small and the shorts focused on them. That's really the bottom line. It's not a strong institution compared to others. And it's basically, like I say, it's an asset gatherer. They're in the asset management business. So I think, you may see Jamie Dimon or even Schwab take them off the table. Why not?